All right, so we're going to be jumping into lower of cost or market, very similar to lower cost or net realizable value. But as we kind of mentioned before, this applies when we're using LIFO or the retail inventory method. And so it's similar in a lot of the key concepts, but of course there are some differences here. And really, what part of it is how we're going to define market. So with lower of cost or net realizable value, there's really only the cost and we compare it to the net realizable value. There's only that kind of that one point of comparison. But with lower of cost or market, we really do need to kind of understand what we mean by market. And we're going to start with that by talking first about what the ceiling is. So the ceiling is the net realizable value, which we just talked about. And when we talk about the ceiling, basically what we're saying is the market cannot be defined as anything higher than the ceiling. And then we're going to have a floor, and the floor is the net realizable value, which is the ceiling, adjusted or reduced by some allowance for normal profitability. And so if we kind of think about the ceiling being, the market can't be any more than the ceiling, the market can't be any less than the floor. And so it's going to be somewhere in between those two values. And so you're going to compare the inventory cost to the market, which is either going to be the ceiling, the floor, or the replacement cost. And the way that I think is the easiest way to think about it is the default is the replacement cost. So you are going to compare the current cost or the cost on our balance sheet to the replacement cost. And we're going to choose the lower of those two. Now, we're going to use the replacement cost unless the replacement cost is more than the ceiling. If it's more than the ceiling, then we're going to use the ceiling. Similarly, if the replacement cost is less than the floor, then instead of the replacement cost, we're going to use the floor. But again, the way I think about it is the default is the replacement cost, is the market, unless it's more than the ceiling or less than the floor. And then we'd either use the ceiling or the floor. So hopefully that makes sense. And hopefully this example starts to illustrate that a little bit better. So we got different products. I think I have more listed here than we actually have. I think there's actually only, yeah, two 100 series and two 200 series products. And so a little copy and paste error there. But all that to say that essentially what we have now is we have some different products and we need to figure out, okay, what's the lower of cost or market for these products? And one piece of information we have here is that the normal profit for each product is 30% of the selling price. So we're just going to define that profit in terms of a percentage. And so now the net realizable value is going to be based on some additional information. So the first step again is with the net realizable value. And before, if you remember when we did net realizable value, we said that additional selling costs were 15% of the selling price. In this case, what instead of giving you a percentage, we just gave you raw numbers. And so instead of saying some sort of percentage here, we just said, okay, for each of these products, here is the remaining selling cost. So we could have done a percentage, but instead we did a raw number. And so just like we had done before, the net realizable value is we compare the selling price and we take away or we subtract or we net it of those estimated selling costs. And so for that first item, 100-1, the net realizable value is 8,200. Again, 10,000 minus 1,800. And we just do that same math all the way down, taking the selling price and subtracting the estimated selling cost. And so we now have a net realizable value for each of those items. And then the next step is to calculate our normal profit margin for each item. Now, when we do the normal profit margin is we take the selling price and we multiply it by that profit margin, which is 30%. And so the normal profit margin for product 100-1 is $3,000. And we do the same math all the way down. 30% of each selling price gives us our normal profit margin for each of the four items. And then the floor is just the difference between the two. So we take NRV, we subtract our normal profit margin, and that gives us our floor. And so again, 8,200 minus 3,000 gives us 5,200. We do that same math all the way down, just taking that difference. And so what we now have is the ceiling and we have the floor. And we're going to carry that forward into our lower of cost or market analysis. So again, that ceiling, that floor that creates the boundary of the market, however we're going to define the market, that's the boundary. Cannot be more than the ceiling, cannot be lower than the floor. All right. And so it's going to either be the ceiling most of the time it's going to be the replacement cost or it's going to be the floor. Now, obviously, in this example, I'm going to create some variation, but in normal practice, a lot of times it's going to end up being the replacement cost. Okay, so what do we have here? So we have additional information, right? So we have the four products, we have the costs as they're reported on the balance sheet currently. Um, we have the ceiling over here, and we have the floor over here, and then you'd have to be given the replacement cost for each. And I just am going to give you that information. So the replacement cost for each item is listed here, 8,700, 11,800, 9,300, and 7,800. Now remember, the market. The default is the replacement cost, unless the replacement cost is more than the ceiling or less than the floor, then we would use the ceiling or the floor. And so let's look at the first one. All right. So we're going to compare the ceiling, floor, and replacement cost for the first product. And so again, default is replacement cost unless it's more than the ceiling or less than the floor. And in this case, we see that it is more than the ceiling. And so in that case, we will use the ceiling as the market. So the market for that product is 8,200. And then we're going to similarly do that same thing. So now we have a replacement cost of 11,800. We compare it to 11,100 and 7,050. We can see that the replacement cost is more than the ceiling again, so we would use the ceiling. For the third product, the replacement cost is between the ceiling and the floor, so we would use the replacement cost. And the final one, the replacement cost is more than the ceiling, so we would use the ceiling. And so the market is defined for each item by comparing their replacement cost to the ceiling and the floor. And then from there, we choose the lower of cost or market. Now, remember, we're not talking replacement cost, we're talking cost on the balance sheet. So we are comparing the cost on the balance sheet to however we have defined the market. And so in this case, the lower of the two is cost. So that's what we bring over. And we do that same comparison. Here we can see the market is lower again here, and then the cost is lower on the fourth product. So we take all that information down, and then we sum that up. And we can see that at the end of the day, that our current carrying cost is 36,400, but the LCM amount is 35,400. Now, if we were tracking this by individual inventory item, more than likely what we would do is we would write down the items where the market is lower than the cost, and we leave the other ones alone. But rather than having like individual journal entries, we're just going to do everything in one aggregate journal entry. And so for this, the aggregate difference between the two is the cost as it is reported compared to the market that we just calculated. And we can see that the market is $1,000 less, which means we need to mark down the inventory by $1,000. And so just as we'd similarly done with lower of cost or net realizable value, we're going to credit the inventory and we're going to debit cost of goods sold. Noting that some companies might use some other account here, we're just going to kind of keep it simple and debit to cost of goods sold. And also noting that realistically, you probably would have individual inventory accounts that this gets tracked to. All right, so lower of cost or market can be done at the individual level like we did, or it can be done by group or by total. And so if we were going to do this sort of in that similar vein of saying, okay, let's instead of doing this at the individual level, again, which we just did, and we're just filling that information in this table, we could also do it by category and in total. And so with each of these, just one thing to kind of keep in mind is the more you aggregate information, the lower the adjustment is going to be because the basically that loss on any individual item kind of gets offset a little bit. It gets kind of dampened because other items aren't being written down. And so let's kind of look at that. And we can see when we look at category, we can see the total cost for this category and the total market for this category, the total cost for this category, and the total market for this category. And what we can see is that with the first one, the group of 100s, the market is lower, but with the 200s, the cost is lower. So essentially, by aggregating across category, what would have been a write down for this 200-1, we're not writing that down anymore, right? So there's a little bit of a difference there. And basically that aggregation changes things a little bit. So when we carry that forward, what we can see is that again, we carry the lower of the two over, we add those up, And instead of 35,400, the total between the two subcategories is 35,700. And so that difference, instead of being $1,000, that difference is only $700. And so our adjusting entry would only be $700 instead of the full 1,000. All right. For the next one, now we're just going to do the total. Again, for the total, we're going to compare the total cost to the total market. And again, we're going to use the lower of the two. And in this case, the market in total is less. So that's what we would carry over. And in that case, we would mark down instead of 1,000 or 700, we would only mark down our inventory 300. Again, the more we aggregate, the more that certain losses get offset by other items that don't have a loss and sort of kind of dilutes the effect. All right, well, hopefully that covers lower of cost to market. We're going to be doing some more estimation techniques going forward, but we'll kind of stop for now.